It appears as though the Chinese government is fighting the online discussion of the protests with porn. And I'm going to show you guys a homegrown opportunity that's currently yielding as much as 10% on an equity yield perspective. And so while you guys smash that like button, let me run that intro. What's up, guys? And this is some very funny news, at least the first part of this video, and I'm going to dive right into this. So notice that the China Twitter grapples with Chinese spam obscuring news of protests. This was reported by the Washington Post. And so what they're saying is that for hours, links to adult content overwhelmed other posts from cities where the rallies were being escalated. And so it's very fishy that that's happening. Numerous Chinese language accounts, some which have been dormant for months or years, came to life early on Sunday and started spamming the Twitter service with links to escort services and other adult offerings alongside city names. And so the result is that for hours, anyone searching for the posts for these cities and using the Chinese names for the locations would see pages and pages of useless tweets instead of information about the daring protests, as they escalated to include calls for the Communist Party leaders to resign. And it looks like it's not the first time that suspected government-connected accounts have used this technique, according to a recently departed Twitter employee. But in the past, it was used to discredit a single account or a small group by naming them in the escort ads. And so that's really funny, but it really tells us that this is a new weapon that's being used by governments to counter information being spread on social media. And so how long until this kind of stuff gets used by our local governments? I don't know. I'm not putting words in anybody's mouth, or I'm not speculating at all either, but I am saying that this is a new tool that I've never seen before, and if in fact it is being used by the Chinese government, is pretty interesting as sort of like the information war continues between the government and the people. Now, once again, this is all speculation. We don't know if it's actually happening, but it's just interesting that it happened at the exact same time that the protests started heating up. But you guys let me know in the comments below, is this government related? Which to me, it kind of looks like it is, or is it sort of like coincidence? You guys let me know. Nobody really knows for sure. Now, this comes as China has clamped down on protesters against their zero COVID policies. So the police have turned out to discourage gatherings in Beijing, Shanghai, and Hong Kong. And of course, the state media is backing Xi Jinping's approach to the pandemic. Why wouldn't they? Why would they speak out against Xi Jinping? That doesn't make sense at all. And so Chinese authorities have tightened controls in reaction to the rare nationwide protests against the country's zero tolerance approach to COVID. So we're starting to see this stuff slow down. However, it does look like a win overall. You can see that under pressure, some cities have announced plans to loosen COVID controls. They're going to start reopening, and public services are expected to resume on Monday. I don't know if they have yet. I'll wait to see that news come out. And it looks like, based on posts on social media, it looks like controls have appeared to start easing. And so they're also saying, the government is, that communities shouldn't set up barriers to block entrances to residential compounds, apartment buildings, or fire exits. So it looks like the protests have worked. This, once again, is an emerging story, so we'll see how this plays out as time goes on. But the one item that I do want to make you guys aware of is, although I'm a big bull on Alibaba, my position in Alibaba is starting to dwindle as there's more cash being added to the account. And so Alibaba is now less than 10%. I think it's been hovering around that 10% for a while, and now it's gone much lower than that. And the reason why I bring that up is, although I never show you guys my portfolio, and I do that for a reason, because I don't want you guys following me. The reason why I'm telling you how much of Alibaba I own is because I want you guys to focus on diversification. Just because something is a great opportunity doesn't necessarily mean that you can't be wrong, or something happens that sort of derails your stock. And so here's one stock that I did like earlier this year, and we did talk about on our calls. I didn't actually end up buying it, but I still think it's somewhat of a great opportunity. So what stock am I talking about? Well, you can see H&R Block is actually up 72%. And this one was one that I was sort of like banging the hammer on earlier this year. I didn't actually buy it because I really thought that it was going to drop. Sometimes I miss these opportunities, and this was one of those where omission really cost me, but that's okay. I didn't predict that it was going to be up 72% on the year, but that's okay. What does it look like now? Well, you can see this is a slow growing type of company. This isn't like, I wouldn't buy into the stock and expect it to roar another 70%. I would expect sort of like a 9 to 11% annualized return, and I'll show you how we get to that. But you can see here, here that the company is projecting growth at approximately 3 to 6% overall into the future. And the way that they're going to be doing that is focusing on small businesses and focusing on financial products. And notice that their outlook for fiscal year 2023 is adjusted EPS of approximately $3.70 to $3.95. So effectively $4. So if you take that $4 and you divide it by the $43.10, which is the current share price, you're just under 10%. So just 9% and a bit of an equity yield. And they are saying that they want to hit double digits adjusted EPS growth annually through 2025. Don't misunderstand that, because they're going to get to that double digit adjusted EPS growth through share buybacks. So it's not just that they're going to organically grow adjusted EPS at double digits. So just keep that in mind as you sort of value this opportunity out for yourselves. And how am I valuing H&R Block? Well, you can see this is my model that the Patreons get access to at that lower tier. And they actually at that lower tier get access to all of my models. And so you can get access to Alibaba, you can get access to Tencent once I build it out, Microsoft, Alphabet, everything just for that $5 a month. But you can see here that although they grew 10% in fiscal year 2021 and they grew 31% in fiscal year 2022, I'm only growing their revenue at 4.5% in fiscal year 2023 and thereafter. And I'm maintaining their gross profit margins at approximately 45%. So not being pessimistic here, I'm just following management's guidance. And you can see that I'm forecasting EPS at approximately $3.88 in fiscal year 2023, which is in line with management's guidance. And so what that's really telling you is that $3.88 divided by the current share price reflects an approximate 9% equity yield, which is, of course, reflecting an 11.1 times earnings multiple, so 11.1 PE ratio. You reverse that, 1 divided by 11.1 gives you that 9%. But notice how as time goes on, this turns into a 10.5% or is expected to turn into a 10.5% equity yielder thereafter. So I actually think this is a great name to put into your sort of like buy and just don't do anything with over the long-term part of your portfolio. So this is one that I would add to my income portfolio. Now, I do have multiple portfolios, and so I would add this one into my income portfolio. Now, the question is, what are they doing with the cash that they generate? I hinted at it earlier, but let's dive right into it and show you exactly what they're doing. So you can see here that these guys are a share buyback machine. They are buying back shares, paying down debt, and paying out dividends with 95% of generated free cash flow. Note how low that stock-based compensation is as a percentage of free cash flow. And so this is an incredibly owner-focused company with a strong moat. And the other thing that I do want to point out to you guys is notice how free cash flow as a percentage of revenue is increasing, and it's now 21.6%. So once again, this is an exceptional company. And so what does my valuation for the company look like? Well, you can see that I'm valuing the company at approximately $56 per share, $57 a share. So compare that to their current share price of $43 per share. It's not as exciting as it looked when it was trading at around $20 per share, when I was saying that it's trading at approximately half of its intrinsic value. But a lot of things were cheap back then, so I forgive myself a little bit for not buying into this opportunity. I did make money on every other position that I did buy except for one this year, which is good, I guess, overall. But the share price as a percentage of its intrinsic value is 76% in this environment. But the reason why I like it is because I look at this as sort of like a dividend yielding opportunity. It's trading at a 9% equity yield, and that equity yield is growing over time. So this is a buy and hold forever in your income portfolio type of investment. Now, the question is, what do they have to say about their long-term growth? Well, you can see here, they're saying that they're going in a direction of revenue growing at around 3 to 6%. They're going to be buying back approximately $1.25 billion in share authorization or shares. And then, of course, past 2025, they're going to re-up that, of course. Now, the other thing that I do want to point out to you guys is that although I'm calculating a earnings yield, they're saying that they're going to be generating a 13% free cash flow yield in fiscal year 2022. So just take that into account as you sort of value this opportunity as well, because you might actually get higher returns in the short term, more than that 9% that what I'm forecasting. So just take that into account. And this is what I mean about their free cash flow yield. So in fiscal year 2022, they actually generated a 13.2% free cash flow yield. So if you're going to value these guys out using free cash flow, just take that into account. Now, of course, H&R Block is not the only stock that I want to include in my income portfolio part of my portfolio. The other name that I'm looking to include very soon is a company that recently announced layoffs of approximately 12% of their employee base. And it's a company that I do expect to do well as time goes on, although I do expect them to have some short-term challenges. And that company is a company that's also owned by Warren Buffett's Berkshire Hathaway by the name of HP. And so you can get to that video right here.